Good morning. It's Tuesday, the 30th of July, and this is Govindraj Ethiraj, headquartered and broadcasting and streaming from Mumbai on most days, but still in transit. A fresh reminder, I'm traveling and thus will be intermittent and miss an episode for the next 2 days. The Take, a nation of young gamblers. So, some 1 in 3 individuals who trade in equities or stocks in the cash segment trade intraday or the same day, which means they could be potentially buying in the morning and selling by afternoon. The share of these young intraday traders, which is age less than 30 years, has grown to 48% in the last year as compared to 18% about 4 years before that, says a new report released by the Securities and Exchange Board of India. On top of this, the share of very small traders who have an annual intraday turnover of less than 50,000 rupees increased to 56% in the same year from about 27% 4 years before that. So here's the rub. Some 7 of 10 individual intraday traders, that's about 70% in equity or the cash segment, incurred losses in the same 22-23 year or net losses. The proportion of loss makers increased further to 80% for traders with very frequent trading activity. And finally, the percentage of loss makers for younger traders, that's age less than 30 years, was higher, about 76% in the last year as compared to other age groups. So young people who are entering the stock markets are trading incessantly and losing money at the same time. So there is much more granular information on this in the SEBI report, but most of it points to what you've already intuitively concluded, which is that a lot of young people are in the stock markets, have entered in recent times, and are effectively gambling and losing money. The fact that they are less than 30 would also suggest that many of them have joined the stock markets in the last 4 or 5 years, at least a majority, which in turn fits with other anecdotal and real data on the big jump in speculative investments during and following COVID. So while we're talking equities here, we've obviously seen similar bumps in other areas like Bitcoin, which are not regulated as such in India. Elsewhere, the Reserve Bank of India has said that it's monitoring loans with a ticket size of up to 50,000 rupees on the books of banks and Fintech lenders. The Reserve Bank of India manages the banking sector, and the Securities and Exchange Board of India manages stock markets. A majority of consumers in this segment service 3 live loans, and it is suspected that this could be an indication of evergreening with the possibility of diversion into capital markets, according to the Business Standard. I am interpreting this to read that essentially people are taking one loan to service another loan. Earlier, the Reserve Bank of India, that's in November last year, asked entities that it regulated to review their exposure limits for consumer credit and also put board-approved limits for various sub-segments. Again, unsecured consumer credit exposures. While no sizing study has been done on this segment of loans, data from the Fintech Association for Consumer Empowerment shows a big growth in such offerings, given, no surprises for guessing, by new age fintech lenders. Or put it more simply, the easier it is to take a loan through a swipe on your smartphone, the more people will borrow as they are. So how big is this segment? Well, bigger than you thought. Last year, loans given out by such firms had touched almost 150,000 crores. But more than that, this was up almost 50% year on year and spread over about 10 million accounts, which in itself was up about 35%. So the total size of loans has obviously increased very sharply, almost 50%. And the number of people who are taking these loans is also up quite sharply, which is 35% to 10 million. The interest rates are obviously high, but these are similar to credit cards. Now, loans are priced about 30% levels per annum, and tenures for these loans are between 3, 6, and 24 months. Now, there is no sign, at least from these numbers, that something will blow out, but it does not have to. The numbers, by the way, say that the overall portfolio at risk for 90 days has actually improved since the last 2 years, and it stands at about 3.5% right now. People may service their loans eventually by borrowing from elsewhere or selling some assets. Of course, people are also trading stocks and potentially borrowing for it because they're fighting inflation and rising cost of living on one hand, and on the other hand, steady or steadily rising incomes and, of course, rising aspirations. For example, smartphones, of which 75% are financed when bought. So the larger point is that this makes it an anxious generation, which is also realizing, hopefully, the perils of indiscriminate borrowing and then playing with those funds in speculative instruments, at least in this case. Even if the funds for those speculative investments were coming through incomes or elsewhere, it's still a loss for many, as the data shows. Now, this is not a productive use of either time or money for India's youth, apart from the fact that many are starting their lives possibly in debt and stress. So my sense is that the threat and concern is not so much the system itself, because the Reserve Bank of India, or SEBI for that matter, seem to be alert to the problem and hopefully will keep tightening the screws as they are. My concern is that we are fostering, or rather witnessing, a growing nation of young gamblers. And that brings us to the top stories for today. The stock markets hit new highs but turned jittery. Oil prices are down, now around $80 a barrel. How is industry viewing the government's moves to boost jobs and create internships? Why it's not all rosy for India's cement industry? And finally, Spotify stocks surge after record net profits and strong growth in paying subscribers.
This is the Core Report with Govindraj Ethiraj.
The stock markets are jittery as they wait for new signals. The stock markets on Monday opened at record highs, with benchmarks BSE Sensex and the NSE Nifty slowing down during the second half and settling finally on a flat note. The BSE Sensex was up only about 23 points to 81,356, though it had hit an all-time high of 81,908 in early trade. The NSE Nifty 50 was up barely a point, ending at 24,836, but also hit a record high of 24,999, just short of 25,000, a psychological mark I'm sure many are waiting for. But equally, market participants are getting jittery, with the Nifty rising to that 25,000 point level, as valuations obviously are high after that strong session on Friday, according to analysts who spoke to Reuters, who also added that the strength in the mid-cap stock segment shows that the overall market sentiment still remains positive. Speaking of which, the small and mid-cap indices outperformed the blue chips on Monday and rose about 1% each, and they all, I guess not surprisingly, hit record closing highs. Meanwhile, while the IPO, or the initial public offer boom, is on, the Securities and Exchange Board of India is returning draft papers of IPOs to merchant bankers, citing reasons for lack of due diligence or disclosures, in a strong signal to investment bankers who manage these according to money control. The point, of course, here to me is that even if issues or IPOs are clearing SEBI's diligence requirements, you still, as an investor, have to be very, very careful, particularly amongst the newer companies. Oil prices are down. Meanwhile, in what must be good news for India, which is otherwise facing a higher oil import bill as Russian oil discounts are going away, crude oil prices are now hovering around $80.20 a barrel. Bloomberg says that oil has been trading near a 6-week low as positive Chinese economic data and renewed tensions in the Middle East were overshadowed by doubts over global demand. And despite the upbeat signals for consumption from Beijing and potential dangers to supply in the Middle East, sentiment in the oil market remains subdued, said Bloomberg. Earlier this month, China reported its weakest economic growth in 5 quarters. Will the government's move to create jobs play off? The union budget recently had a slew of measures aimed at job creation, including incentives to both employers and employees based on their Provident Fund contributions for the first 4 years of employment. There are similar incentives for additional employment and then for internships targeting the top 500 companies who will offer internships and use their corporate social responsibility funds to pay for it. The idea of internship in principle, of course, is a good one, and much of industry and academia are already aligned on this for some years now. Now, this scheme is targeting about 10 million youth, so operationally it might present some challenges. The larger thrust of job creation and internships as a route to that through a mix of incentives and some nudges is possibly one of the approaches to address the larger jobs challenge facing the economy. I reached out to Chandrajit Banerjee, Director General of industry body CII, or Confederation of Indian Industry, and I began by asking him what was his one major takeaway from the recent union budget, and then on to the internship and jobs proposals.
Budget is a big exercise in India, as we all know, but 3 takeaways, if you ask. One of the things which I really got, which I was happy about when the finance minister talked about the macroeconomic parameters, and I think that was a very important thing. I would think that during the budget, she spoke about bettering the fiscal deficit target, better than expected, 4.9% of the GDP for the current fiscal. And we have also retained the focus on capex. I would imagine that was something which everyone was looking at as to how it will play out, whether capex would be, enough of the government-led capex, but keeping that. So that was very important. So it's done very well. The government, I would say, has done very well to commit itself to the fiscal glide path also that it had talked about, which is very important, which really improves our standing across in the world and gives much more confidence for Indian economy. The second part is I see, pre-budget, we were all talking about how do we get the private sector to play more in terms of investing more. Government has done that, but it has actually focused a lot on, if I would think, one scheme that was successful, as you know, was the production linked incentives. So they looked at something which we have been recommending also very strongly, was the employment linked incentives and ELI, which hopefully will bring in much more employment in the country and production, and also private sector participating in the investment story. I think that's another piece that one sort of stitches together as one looks at the budget. I can speak a lot on that, but let me stop there because it leads to skilling, etc., etc. But that's so that I see a lot of trickle effect of that. And the third, I really wanted to say, one of the things that we look at budget is, India has done extremely well in one reform, and I would say that is tax reform and GST, and the way it has brought about GST over the last few years. And I think when the FM talked about, overhauling, or rather looking at the entire Income Tax Act of 1961 in the next 6 months, that shows that we are on a path of looking at bringing down the tax complications that existed, the compliance issues, the decrim part of it. So all of that. So that was a very, very, very good news. So I would sum it up for three. I would give this to be the top three takeaways for me in the budget.
Got it. So on PLIs, that's production linked initiatives, and the new one, which is employee linked initiatives, you're saying that the industry has really played a role in suggesting and putting forth this proposition?
So yes, if you see the pre-budget memorandum of ours and our discussions with the policymakers, one of the things that we have been talking about is, like the PLI, can we have a scheme which is like an ELI, which will be linked to incremental employment creation and incentivizing that, and for which even production will go ahead, your investment will go ahead, and it's completely for the manufacturing industry. So really, it's good for the manufacturing industry, and also it will lead to some other industries if it's well linked to like tourism, etc. This is something that we were talking about for quite some time.
Right. So the way it is going to play out, so the government, for example, has said, that in the case of interns is, of course, different from full-time employment, but there is a process that the government is looking at. I mean, using the Employment Provident Fund as the housing body, making companies use CSR budgets. So is that also something that was proposed, or is it more an evolution from the government side?
We have been talking about how do we create more employment, employability, skilling, and how does industry play a role in it. Industry, of course, will have to partner in it. And the ELI scheme has been thought. Everything is not what we would submit, but obviously the policymakers will deliberate it on it. So I think this is a very unique proposal, what you mentioned about the internship. And it talks about just for 500 companies, the top 500, for 1 crore students for next 5 years. And I was doing some maths. It comes to something like about 4,000 interns to be employed annually by these 500 companies. So it's something which is not I would imagine you are formalizing or putting up a sort of an institutional mechanism, and it's so very important to see such great focus on apprenticeship and in the budget. And this is one way of, I would see this resulting in something formalizing the way interns are sort of encouraged to be taken by the top companies and many more. As you know,
and you're seeing that this is sort of operationally feasible as it looks like at this point, as reactions from your own colleagues?
Yes, I would think that it is
At the scale, okay.
Yeah, I was talking to some of our manufacturing companies again. The feedback that I had was that it is something that, yes, it is done. And it is done anyway because people do take an intern, and it would help them to actually train them formally and absorb them. And or even if we give them a certificate that they've done internship, they get other job opportunities. So I see the numbers. So formalization of the jobs, formalization of training. And I would think that it will be even great. One of the points that was done was by allowing actually employers to offset the cost of training through CSR funds. So you are really putting an enabler there, 10% of the total cost that comes into of the training. I would think that this needs to be expanded further. Industry should participate in it strongly. I would even think that we have opportunity. We have to see how the rules are framed, and that's going to be very critical. I would think that while focus is on manufacturing, I would think even construction industry, which is a very, very critical industry, could be included. And the cost of 4,000 people that we were talking about to be employed annually by a company paying, say, 15,000 odd compensation per month on an average, say, for instance. What does it mean? It means about 70 crores. For the top 500 company, 70 crores of internship training. I don't think that's a cost issue at all. That's a great investment to make.
And they are able to set it off from their CSR budget, which was otherwise perhaps a little restrained.
Yeah, so that 10% gives that. I mentioned about that 10%. That's what we saw. 10% of that cost could be put in as from the CSR. Plus, government is also participating in it. There is an encouragement by the government. So I would think that we should expand this beyond 500 once we see this pilot working well, I would imagine.
And it's possible, I guess, that companies might do it themselves. I mean, a lot of companies take interns, but maybe not dovetailed into this kind of a scheme.
Yes. So if it gets dovetailed into a scheme, it gets formalized. And I think that becomes very important. And many companies do it. Many companies do employ interns. They need interns, and the interns in turn get absorbed. But I would imagine when the rules get formed, there will be some sort of a certification, some sort of a recognition. So the mobility for them, that, it's not like that I've done internship in a place and if these guys don't take me, then I'll have to be retrained by someone else. So there is a proper certificate which I can show that I have got this training. This is a certificate which I have done this internship. My employability, so to say, increases so many-fold.
Right. And what's an unfinished agenda point, CB?
I would think that there would have to be, going ahead, while there has been strong focus in agriculture and rural in the budget, I would really like to see going forward greater participation of the private sector into the rural economy. And this could be, we can think about rural, business enterprises, what could be those which is an easy access to market type of rural, non-agricultural rural businesses, non-agricultural rural jobs. And I think that facilitation and that collaboration would be very important, and private sector has a huge role to play in that. And the second, if I may, is, going forward, we would need a very strong tech enablement of our industry. The large companies know how to do it. So the digital transformation of companies, of the small and the mid-sized companies, access to capital for digitization, so to say, those will be critical areas of our work as we go along. And I'm sure much of it can come even from outside of the budget.
Right. CB, thank you so much for joining me.
Thank you. Thank you, Govind.
If you are an entrepreneur or run a large enterprise, you would have thought or are thinking about how secure your customer data is or how secure your systems are to dodge potential cyber attacks. While a mere software update failure could bring airlines, banks, and even hospitals world over to a grinding halt, as it happened in July, imagine what a targeted attack could do, particularly if it's successful. And attacks are happening all the time, even as you hear this. With this as a background, we're launching our first offline meetup in Mumbai, the Core Cybersecurity Dialogues 2024. That's coming up in September. Stay tuned for more details. What's going wrong in India's cement industry? In our discussion on the consolidation of India's cement industry yesterday, we noted that there is a large gap between production and capacity. India has an installed capacity of about 600 million tons, but production was only about 391 million tons as of last year, as per data via the Ministry of Commerce. The latest numbers are a little different, and we'll come to that, including the fact that some of the capacity is not usable or functioning and thus reflects a total capacity utilization of about 78%. On Monday, the managing director of India Cements, the company that's being acquired fully by Ultratech belonging to Aditya Birla Group, said in a speech to employees that a price war by competitors can crush the company, possibly as a rationale behind setting out. The 79-year-old veteran N. Srinivasan said that there was no need for anybody in India Cements to feel insecure or threatened, but the problem for India Cements was, in his words, the company's inability to sell its land parcels to tide over a financial crisis, also acknowledging the higher cost of production and the steps taken to reduce costs. India Cements has about 26,000 acres of land in Andhra Pradesh and Tamil Nadu, and their plan was to monetize the surplus land to cut down debt and for capital expenditure, but they could not do that. India Cements has a total debt of about 2,500 crores, but the company is an old one. It was set up in 1946. And after acquiring Coromandel Cement at Kadapa in 1990, became the largest producer of cement in South India. I reached out to Ronald Siyoni, Associate Vice President at Sharekhan by BNP Paribas and a cement analyst. And I began by asking him how he was seeing the gaps in demand and capacity and how that was affecting the financial standing of cement companies before then looking at the overall outlook for cement, particularly from a demand point of view.
Industry capacity is around 600, to be specific, around 626 million tons. But the consumption, which was around 425 million ton in FY24, but about 50 million ton capacities are inefficient and hence they do not actually operate. So if we exclude those capacities, then the industry capacity utilization would be around 78% in FY24 compared to the 70% in the earlier assumptions. So we have seen increasing capacities each year.
Right. And what does this mean? So we have obviously the few large players, including Ultratech and Adani through ACC and Ambuja, and there are a lot of smaller players. So where is this, let's say, the excess capacity mostly housed in?
Yeah, if we see for FY24, industry added around 41 million ton of capacities, for which Ultratech's share was around 32%. And for FY25, also 60 million ton would be added, of which 40% roundabout would be commissioned by Ultratech. So major large players have been adding capacities last year, and this year too they would be adding the capacities. Predominantly, wherever the growth has been, like in the prior year, the growth was more concentrated to eastern regions. So many players ventured into that region. Most of the larger players were looking for capacity additions there, and now the growth has to southern region too, where after the budget there has been a much more focus on the improvement in demand which is expected in the southern region, especially in the Andhra Pradesh region, as the larger players are looking now adding capacities in the southern region.
Right. So you're saying that while there is industry still operating around 78% of capacity, people are also adding capacity much faster than demand. And or is it because the demand is split so regionally and obviously cement is not so mobile? People are adding capacity in one part of the country while actually maybe sitting idle in another part of the country.
Capacity additions should also be looked at, how they are being added, whether it's a organic food or an inorganic. So if greenfield capacities are coming up more and more, then it is a headwind for the industry in terms of new capacities getting added. But if there is a consolidation in the sector, there are larger capacities getting absorbed by major players, then the industry capacity overall remains same, while there will be only a small amount of greenfield additions. So that kind of consolidation is better in terms of demand supply mismatch.
So the 60 and 70 million tons that you said, that's more by acquisition rather than greenfield?
Actually, that's a mix of both, but these numbers, are dynamic, because if you see 60 million ton capacity additions, that if say suppose Ultratech has now gone and taken up India Cement, which has around 15 million ton of capacities, then that incremental capacity could get delayed. The greenfield expansions the company would be undertaking may get delayed by a year. If there are larger inorganic acquisitions, then greenfield capacities would come up a little bit later.
Right. So one of the things that the India Cement's managing director said in his speech to his employees was that a price war by competitors could crush the company, and also pointing out that their cost of production was high. What's the general outlook on the cost of production versus the kind of margins that are there in the cement industry? I mean, this is a broader question as you look ahead, Ronald.
Right. So, previously we had headwinds in terms of power and fuel costs with respect to rising petcoke prices, but now that has eased. And now it has, come to a point where, players have been able to better manage their costs. And hence, you are seeing some kind of competitive environment in which industry players are looking for market share additions. There is, of course, power and fuel costs are expected to remain stable, but there has to be a pricing discipline in a way. So currently, whenever a quarter or two where there is a weak demand environment, as we had seen during Q1, where there was an election period, in Q2 there is a seasonally weak period. So such quarters may have pricing pressure in the industry. But post those quarters, when we see a stronger demand in Q3 and Q4, I think the pricing can remain stable and in fact improve if the industry demand, outpaces the expectation of the players.
Right. And if you were to look at, let's say, the average selling price of a bag of cement across India versus the cost of production, how does that stand?
If I specifically, because that's a moving number, but if I specifically take the case of Ultratex, then its realization per ton, I would look at around 5,600 to 5,700 currently after the price decrease. And, about 4,700 to 4,800 rupees cost per ton. So, larger players are getting 1,000 rupees EBITDA per ton, give or take around 50 rupees per ton here and there in a quarter. But around 1,000 per ton, EBITDA per ton is profitability is there. So the difference between the realization and the operating cost of overall.
So, in percentage terms, would that be consistent across country again or across the major players?
More and more, we have seen variation. Like Sri Cement used to get, around 1,300 rupees EBITDA per ton. It was at the premium. But, Ultratech caught up and, they in fact paid of three times Sri Cement in some of the quarters. So there was a peak profitability, for Sri Cement. And that's why Sri Cement was valued at a premium to Ultratech. But now also these companies, wherever they are able to save on power and fuel costs, wherever they are able to increase the green energy. So each and every cement companies nowadays, whenever you are speaking to them, they only talk about reducing their overall OPEX per ton, operating cost per ton. And two, three key levers are there. First is basically the green energy, power and fuel cost. And second being the savings in the freight cost and sales volume or operating leverage. So more and more companies are trying to focus on reducing their overall cost of operating cost per ton.
So, you said, that demand had actually gone down from the 426 million tons earlier. Now, how is the outlook for, let's say, the next year or so?
For FY25, we are expecting industry to grow at 7 to 8% YY. But that being said, most of the major players are eyeing double-digit volume growth, and hence we are kind of seeing the pressure on cement prices continuing, post quarter 1 also. And the industry, this is a back-ended growth where 7 to 8% YY growth means S2 should be heavy, and that we are also expecting the same. So once the government has stabilized and the government's infra spends and housing spends also kickstarts from Q3 onwards post the monsoon season, then this 7 to 8% industry growth can be expected. And for larger players, a double-digit growth can be expected.
Ronald, thank you so much for joining me.
Yeah, thank you.
Spotify stocks surge. No, they don't pay us, but they do host us free of cost and help us reach you. Not surprisingly, would you say, Spotify shares hit a 3-year high after the Swedish audio streaming giant reported a record profit in the second quarter and strong growth in paying subscribers, according to Bloomberg. Paid subscribers increased 12% from a year earlier to about 246 million, also beating an average analyst estimate compiled by Bloomberg, and monthly active users were up 14% to 626 million. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.